Alright, I think we're going to get started now. We've got enough people here. So, welcome to finance and sort of like money and economics and stuff. I just want to start off with, people don't like this. And I think that's because a bunch of people learn on the job what all of this means. Right? Like people learn about economics by doing an economics debate. And it's hard, and maybe someone else knows something. But I promise, they can be very, very fun. And hopefully I will go through enough of like all of the rules and information that everyone enjoys it as well. Alright, let's get started. Firstly, just a bit of housekeeping, because economics is quite broad. I put 3 things there. Firstly, there is a lot I'm going to cover. Please ask questions as we go. I think that might make this easier. Secondly, the way this seminar is structured is it will start small and get sort of progressively bigger, so starting with individuals, going to like governments and companies, and then lastly sort of like international agreements, etc. There will be some tax stuff in there because Annika asked me to put it in there. It is not financial advice. And lastly, yeah, there will be a lot of debates, but I'll sort of link them all at the end for some people who'd like to watch them. And then I put there just some quotes to elucidate. All of this can be incorrect because one of the golden rules in economics is it depends. So that was a quote given right before the crash of Lehman Brothers, I believe 3 weeks prior. And then this one was Bernie Madoff about 2 months before he gets like indicted for a bunch of crimes. So broadly, some of this stuff can go wrong and be weird and be very, very funny. But it's sort of going to progress like it will. All right, here's the structure. Firstly, personal finance, so like the market and you and what you do. Secondly, the economy and the state. And then lastly, the sort of Henry Kissinger on hot ones. Who do I call when I once called Europe? So developing economics, all that sort of stuff, which I think is probably the most fun. All right, just before I go on, some general tips with economics rounds. And helpfully, I've like attached some debates to each of these so that if you'd like to, you can sort of see how you can go about doing these things. The first one I put is that clarity is paramount because there are a lot of claims. I genuinely don't know why everyone has this tendency in economics debates to just say as many things as possible and hope the debate ends, which is why, especially if you're on opening, it can be incredibly important to just say a few things memorably. The example I put there is David Wu from the Australs quarterfinal in 2023. And essentially the debate is like, well, should we tax a bunch of people a little bit, or like a few companies a lot, and which one is better for the countries? And David's example is just like, if I asked all of you to sort of pay $1 to come into the debate, you probably would, it's not very much money. But if I asked like Trotter was the chair, to pay like $200, he's just leaving, right? Like he's just going home. So essentially it's like explaining things simply is probably the most important thing you want to do. It's something you want to think about from prep. Secondly, just call bullshit. The judge understands as much as you do. So the example there is from a world semi-final, which is not Kevin Lee, big Kevin Lee. Essentially, the claim made was, it was like some stupidly long point of information about, how Algerian debt would be influenced by something. And Kevin Lee's response is just, I don't understand what the hell you're talking about. And it works, like he goes through. So I guess so does the other team, but that's fair enough. Third thing, don't get distracted by dogma. People get really into being like, companies really, really bad, or the other way around. Like I've seen Jordan be like, companies really, really good. Don't get distracted either way, be rational. There's a nice Eden Blair speech on like capitalism being incompatible with feminism, and she's just like, well, let's be reasonable here, and then gives a bunch of sort of sensible arguments. Those are almost always bad. Lastly, this doesn't have a debate, but it's got sort of like a correct quote, which is the best thing to do if you're stuck for arguments is just to try and argue for the reverse of what the other team says. I think this can be incredibly useful, especially if you're on opening. Economists disagree, and there is a whole lot of confusion for a very good reason, like things go either way. And then lastly, you may not be interested in economics, but economics is interested in you. So economic arguments are not useful in economic debates, they're useful in many debates. And the example I put there is the Paul Australs debate, which is like, this house prefers a world in which one parent remains at home. And the very simple argument that Neg made in this debate is, well, if half as many people work, half as much stuff is made, and that means people are poorer, and that's bad. And it's like a very simple argument, but it does just win the debate. So, I don't know, take these things each with a grain of salt, but I think they can be pretty useful. All right, first section, personal finance, the market, and you. So, part one is how to get rich. I've structured this into a few things. Firstly, like personal finance briefly, then, like what will the price of an asset be, and then like some interesting context. So, firstly on personal finance, there are a bunch of sort of information and online bullshit around like, how to sustain a bunch of money. I've condensed like the best personal finance advice that exists into like a few key dot points. The first is that compound interest is really like the name of the game. So if you put $10,000 into the market 30 years ago, it would have been worth whatever amount of money that is, $174,000 today, from doing nothing, essentially. And the key findings of most individual personal finance data, people going through a bunch of people's tax returns, savings, etc., is just that if you can put away a tiny amount of money semi-regularly into just the market as a whole and don't touch it and do nothing with it, you will sustain a whole lot of money relatively slowly. The second thing, I think this is probably the most useful for debating. There's a very nice book called A Random Walk Down Wall Street, which essentially, the premise of the book is, this was written like 40 years ago, this guy took a bunch of monkeys and sort of got them to throw darts at a sort of a stock portfolio and just picked the stocks at random based on the ones that the monkeys selected, like, like the monkey typewriter thing. And it found that on average, after 30 years, when accounting for fees, they outperformed 98% of stockbrokers, which I think is quite funny, but elucidates that most investing is actually psychological. So when you choose to sell is often more important in terms of whether or not you make money, so people panic and make bad decisions. And the best thing to do is just sort of buy the market as a whole rather than to sort of pick any one thing, because you'll most likely get it wrong. And then lastly, I put sort of like some very, very brief taxation advice, because Annika asked me to do so. And that is that the general principles around tax is that the IRS or the, like the ATO, they know far more than you do. Like they know basically everything except for the cash that you get. Report your income, but declare and write off stuff that you use to get that income. So I think the finding, I think this was a few months ago, there was a precedent set that stuff like SSAF fees can be written off, which is quite useful. So, like anything that you use in order to get a certain amount of money, you can write off to make your income smaller, etc. And then I put that quote there, in the long run, we're all dead, because, like, some of this is important, but to be honest, some of this is important, but to be honest, like the most important thing is just having a good time. All right, some more debating, like actual useful information. What will the price of an asset be tomorrow? This is a question that people spend billions of dollars trying to find out. How much will a stock be worth in a few days? And there are sort of two prevailing theories. The first is this thing called the efficient market hypothesis, which is important to understand when you're doing most sort of buying stuff related debates, which is the present price of something is a product of all future expectations about it. So I did a debate, I think it was like at the start of uni debating. The topic was something like that we prefer the government to buy and fund a bunch of small and medium-sized firms, so like like your cafes, your manufacturers, etc., to buying startups. And I absolutely screwed this debate up. The argument that we made was like small, medium-sized firms are really stable, so it's a good deal. And the argument the other team made was like, well, startups can go to the moon and become really, really expensive, and so it can be a really good deal for them. The problem is, both of these things are actually priced into whatever the current price is, so neither of those arguments are at all useful in the debate. Because you just explained why, if it's very risk-free, that would just mean it's more expensive because of that. And if it could go to the moon, that's a reason it's more expensive because of that, right? So everything is priced in. But the sort of asterisk to be made is that price is actually just a product of sentiment, often more so than like information. So the facts I put there, and it was 3 days ago when I wrote this, Nvidia went up by as much as the entire value of McDonald's in one day, which is absurd, and is much, like, without actually doing anything. Like, it's not as if they bought all of the land that McDonald's has or added any of that value. They sort of just reported earnings, and people assumed that they would grow more, and so the market currently is in a bit of a bad state, which is that most companies are trading at 35 times the actual amount of money that they produce. So people are assuming that the market and everything else will grow because they've sort of priced that into the current sort of valuation. So essentially, it's pretty bad. Everything is very, very large and stretched very, very thin, which could mean nothing, but also could be very, very bad. Okay, the next part is like things that you can invest in, and this is like very, very brief and debating related. And I put up there some tweets of mine that I think are funny, just in case any of this gets a little dry, you can look over at those. So, the first thing is shares. So, I'm glad people are laughing. Shares. shares are essentially like the piece of a public business that you can buy, and the important thing to note about them is you don't pay tax when they go up, as opposed to other things. So if I put my money in the bank and it sort of grows, I have to pay tax on that. If I buy a share, until I sell the share, I don't actually get anything from it. But the sort of important note to make is, whenever you're buying a share, someone is selling, and whenever you're selling, someone is buying. So the question you have to ask yourself is, am I the idiot on this side of the transaction? Which I think can be pretty important. And then lastly, in terms of like actually picking a stock, it's not a piece of paper. A stock is a reflection of an actual business. And the best way to find out if you're getting a good deal is to understand what the actual real business is worth. Okay, index funds, these are very brief. They're essentially just a broad reflection of the market. They don't lose, which is a good reason to say that they're probably the best thing if you have a little bit of money, just to put it in an overall reflection of the market. Because you're not betting on any individual stock, you're just making a prediction that on the whole, things will be better in 10 years than they were 10 years ago, which I think is a much safer bet than any sort of specific business. And the maths behind why they work is that losses hurt you far more than any benefit. So if you lose a little bit of something, like 50%, you have to make 100% returns to go back to where you started from. So the name of the game is just not losing. Lastly, shorts. Shorts are broadly just a bid that, or like a bet that the price of something will go down. Like there's a whole lot more sort of like maths behind them, but it's essentially just betting that asset will be worth less tomorrow rather than more tomorrow. And there are sort of some other interesting things about them, like there are these firms that will short something and then will do a bunch of research into why that company's bad, or do a bunch of research into bad companies and then short them. They're pretty interesting. Okay, the last part of this is like things to invest in, and I've sort of put them into two buckets. The first is boring and the second is fun. So the boring ones are pretty basic, but they're important to understand. Cash is generally not a great investment because it will never go up if you just sort of have it, and it will constantly be eroded and destroyed by inflation. The only instance in which cash is good is if you think there will be an enormous crisis sometime in the next few years, which is why it is slightly concerning that most firms and Warren Buffett have the most cash they've ever had, which again, could mean nothing. Bonds are broadly just an IOU, so the government will issue something like a bond, and so they'll say like, give us 1,000 of your dollars, we'll give it back to you in 2 years with a little sort of payment, like a coupon payment along the way, and they're considered the like safe, risk-free thing that you can buy, and they set essentially the benchmark of returns for most companies, because like if they're entirely risk-free, you would invest in them unless there's something that can give you better returns. Real estate, it's sort of like, it's what you make it, it's a house. And then commodities, I've just put like, you become Gollum, because essentially commodities, you don't really get anything out of them. You sort of just have to hoard them until the price goes up and then hope that you can sell them for more. And you really don't want any more to be found. Like if you've got oil, you're praying that no one else finds oil. They're a really silly investment. Then I've got the fun ones. So currencies are crazy, incredibly hard to predict. There was this thing called the yen carry trade, which was essentially just like a trade people made where they borrowed a bunch of Japanese currency because Japan had like no inflation, and used that to invest in the US and then hope that the US would inflate, which was perfectly fine until Japan started having inflation for the first time in like 30 years. So like fine until it's sort of suddenly not fine. The second thing I've got there is put it on black, which is you just go to the casino and you put your money on black on the roulette wheel. The reason I put that there is that it actually has better returns on average than cryptocurrencies and decentralized finance, which should give you sort of some appreciation for just how terrible they are. They have like no underlying value, they're used for crime, they're very volatile, and I've sort of linked a debate where Liam Mercier in like 2022 Australs gets an 80 for saying they're very bad. They're very bad, don't invest in them. Try to be on the side that's regretting cryptocurrencies and decentralized finance. That will help you. Okay, next I've got sort of carnivores and the market food chain. So I put them into like 3 little groups. The first are pension funds and asset managers. I've sort of like, the easy way to remember them is they're like ours, but not ours. So pension funds and asset managers like Vanguard, State Street, BlackRock, they've got a ton of money that is not entirely theirs. It is like, it's not as if they sort of came across this money. It's that people invested their savings in them or their pensions in them, etc. And they own way too much. So there is like some figures. They have more GDP than most countries, which is kind of absurd. The second one I put there is the money makers. These are the ones that are probably the more interesting ones to know about for debating. So the first of which are quantitative traders. So they're like the nerds. Essentially, these are like the top firms that use algorithms to sell stuff and make sure that the market goes. And they seem like relatively silly and, you know, like just a sort of person. They're incredibly instrumental because for most people, when you buy a stock, you're not actually buying it off another person. You're buying it off one of these firms who conduct like millions of trades every single day. So they essentially just like sell over and over again and have a bunch of algorithms that sort of try and predict when things go right and like, you know, how they can sell at the right time. They also conduct like a bunch of very interesting maths about like, you know, if the temperatures go up a little bit, oil production will be like slightly slower or something like that, which will make things slightly more expensive. Like they're a bit silly, but they're essential for the market. The next one is private equity. So these, I think the best way to think about what private equity is and does is that they are property developers for private companies. So private companies can't traditionally be invested in. However, private equity firms really do a thing called like a leveraged buyout, which is it's essentially just property development for businesses. They go to the bank, they get a loan, they use that to buy a company, and then they, in the same way that a property developer would like knock down the house and build a bunch of flats, they will try and like juice it up as much as possible. So they do a bunch of things that are sometimes good, but also a bunch of things that are sometimes bad. So for example, private equity can force a company to pay themselves fees for consulting. They can make a company take on a bunch of debt or pass their debt over to a company, or they can sort of just like monopolize every step in the supply chain. So it can be pretty bad. Hedge funds, the note I've put there is just scammers for the rich people. Broadly, the way that hedge funds work is that they have a threshold, so only people with over $1 million can actually buy into them. And they charge like huge fees on the proviso that they'll make money. Sometimes they do, sometimes they don't. They're a little bit sketchy and most people never really have to interact with them. And lastly, banks. Banks are sort of like the blood of any economy. You've got investment banks which deal with some companies, so they'll like merge them or give them some advice. And then regular banks, which I know people sort of laugh on them a little bit, but they're actually entirely instrumental. Like they make sure people get home loans, car loans, etc. They're pretty important and set all that stuff up. All right, let's move on to what I think is like the more kooky and interesting stuff. So this is the stuff that is probably realistically more useful in debating, which is Leviathan, the economy and the state. So the first thing is government spending and how it works. I've attached a little fact there at the top, which is that the US national debt is currently at $34 trillion, which is more than $100,000 of debt per person, and it is actively getting way worse very quickly. So the US spends about $2 trillion a year, and it makes in taxes about $1 trillion. So every year its debt is getting worse. And it does need to be paid back. Like, people think about debt as, well, every country has a little bit of debt. No, they have to actually deal with it. And if they don't, it can be incredibly scary. The way that they currently do it, so the way that Australia deals with its debt and the US deals with its debt, is they refinance, which is essentially just they roll over the debt and charge themselves a like higher interest rate. So they've got to pay more to keep it going, which just means, of course, you're paying more and not doing anything with the debt, which is really bad, and again, sort of could mean nothing, but it's bad. Yeah.
Who's the debt to?
Who's the debt to? Good question. Mostly a bunch of other companies and countries. So when the government raises bonds and sort of sells them, so they'll sort of they'll say to a person, give me like $1 million and I will give it back to you in 10 years. And they use that to build a bunch of sort of roads. And in most cases, the person in question is just another government or another entity or institution. And what's happened is that it's been 10 years and they're like, we just don't have the money, we'll give it to you in another 10 years, which is slightly bad and, you know, like, again, could be nothing. Next, the fiscal multiplier. This is a stupid economics term, but it's like essential for most debates, which is when the government gives money, that money like goes through a bunch of hands and is incredibly useful. So if I give Jaquil like $20 and Jaquil has like $20 worth of debt to Abra, who has $20 of debt to Helena, who has $20 of debt to Bibi, who has $20 of debt to Will, and then Will has $20 of debt to me. If I give Jaquil that $20, it will bounce through all of you and then come back to me, and all of your debt has disappeared, but I've only spent $20. So essentially, when you spend on a business, that business will give the money to its employees, who will give the money to, you know, like businesses in their area, and will sort of multiply around. So it can be very useful in that regard. Then the last thing is debt denomination. So essentially, a bunch of countries have their debt in GDP, which means that inflation to, their debt in USD. So if they inflate, or if the US dollar inflates, it's not just bad for America, it's bad for all of the other countries who have their debt in American dollars or who rely on that. And that could mean like, a problem in one country very rapidly spreads to other ones. Okay, let's now talk about regulation. I'll be slightly more brief on this one and then spend a bit more time on the case study at the end because it's more sort of practically useful. So the provinces of India thesis was about 2 provinces. The first was Gujarat and the second was Karnataka, which essentially represent 2 different ideologies of sort of public versus private intervention. So Gujarat was Modi's city. He made it an investor's paradise to try and attract more money. And Karnataka was more of a like government-financed IT giant. So it was specialized in just like getting a bunch of government jobs and stimulating it with the government. And this is, I think, a whole lot of debates where they're just like, should the government do it or should companies do it? Broadly, there are a set of reasons that I think are pretty obvious for both sides. So government is probably more equal, it can deal with stuff like externalities, and it's more strategic, which is, I think, the one that's more circumstantial and quite useful, and often, though, can be bad. So it can be corrupt, and I think especially can be like ethnically corrupt. So governments that are biased in a certain way can give jobs to certain people that maybe end up being stratified in bad ways, and also can be overzealous. So the debate I've attached there is my favorite debate of all time, which is a quarterfinal of ANU Spring, where the topic is essentially like, should we enact a bunch of regulation on the government? And closing opposition, I believe, are like, and the regulation is like, should we consult with people? And closing opposition's extension begins with like, consult with who? Fucking squirrels? And ends up being like very sort of good, and essentially just like critiquing the regulation very specifically. So I think this can be useful in terms of most debates where you have regulation, just like actually dealing with the minutiae of how it will work. And then lastly, I've attached a case study that is like actually quite pragmatically scary, which is the Chevron case. So the Chevron precedent was established like 40 years ago. It's the reason that cigarettes are banned on most planes, which is that there's no actual like federal law saying that they're not allowed, but the regulators had this sort of provision, had this precedent that they were allowed to take reasonable actions into their own hands to try and keep people safe. So they were like, well, reasonably keeping people safe on airplanes means we should like ban cigarettes, but there's no federal law to do that. And around 2 months ago or a month ago, it got repealed, meaning that all of those laws now have to be enshrined federally to actually exist, which requires a huge amount of bureaucracy, and I think it can be slightly bad. All right, reserve banks. This one are like, I think people don't really understand what it means for governments to like print money. So I wanted to briefly explain that. So how does inflation actually occur? Like what is the physical thing that happens when we get more money? Which is that it's not as if there is like an actual money printer. It's that the government will issue more bonds and then give them to the Reserve Bank, and the Reserve Bank will sort of now have them for free, but technically they're worth money, and then we'll sort of sell them out into the market and into people. So essentially it's that the government will just create bonds and not money and give them to the Reserve Bank and say that they're worth a certain amount of money, broadly. Okay, why is inflation very, very bad? These are a few points that I think can be useful in terms of using extensions, like, inflation is commonly not analyzed as to why we shouldn't do certain policies. Like, most often in debates, it'll be like, well, if we give someone a certain amount of money, it would be better than if they didn't have that amount of money. But actually, often it is the case that the most prominent concern for most countries is dealing with inflation. And here are sort of some reasons why. The first is that not everything inflates at the same time. So if you have $60,000 worth of savings and a huge amount of inflation happens, your savings are not going to inflate, but the price of goods will inflate. If they're just sitting in the bank, like your savings aren't going to radically become worth more, but the cost of everything will go up. The second thing that is inflationary expectations. This is why inflation is really difficult to deal with. If I think that inflation is going to happen tomorrow, so my money that I've saved is going to be worth less, I will spend my money now while it actually has value. So the theory that inflation will happen creates inflation. It is a self-fulfilling prophecy because people believe inflation will happen and then spend money to sort of do it before their money loses value, which then creates the inflation. And lastly, inflation is very, very sticky. So once it happens, it's not as if we can take money out of the economy, which makes it really, really difficult to deal with. And it also means the government can't spend money because that will create further inflation, which is pretty bad. And then lastly, what do reserve banks do? Like what is their like actual function dealing with inflation? The way that I think is sort of best to describe this is interest rates are like gravity to matter in terms of like the market. So when the interest rate is high, it sort of pulls everything back down to earth. So when it costs more, for example, to take out a loan, or costs more for a business to buy a new building and get a loan from the bank, people do it less. So people spend less of their money and they save more of it because the interest rate holding your money in the bank is now it's gone up, right? So people spend less of their money and it sort of pulls everything down. And it means that people broadly withdraw their money from the market. So the Federal Reserve, which is the United States equivalent of our Reserve Bank, will put down interest rates when they're worried and they want people to spend, and they'll put them up when they're trying to deal with inflation. And here is a little news clip from 2007, which is markets saw after Fed cuts key rates by 0.5 point, which immediately preceded the economic crisis of 2008. And as of 3 days ago, the Federal Reserve has just cut rates by 0.5 point, preceding incredibly high unemployment, which again, could mean nothing. Okay, the last part of this sort of presentation is international issues and how you can deal with them. So how we can, for example, talk about trade, interventing, and aid, and all of those things. So first thing here is trade. I think this is a good quote from John Oliver, which is, trade is a lot like sex. If you keep promising you're always going to come first, you'll have a hard time finding partners. So, free trade is sort of like a prisoner's dilemma, which is that everyone wants to do protectionism, but only for them. So you want everyone else to trade with you and not have any tariffs, and for you to be able to trade with them and not have any tariffs. But you want to do protectionism on yourself and make sure that your industries are safe. So you'll get a whole lot of debates about this. Usually they're policy specific, so they might be about there was one about the carbon border adjustment mechanism. There was one at APDC about the environmental reform, stuff like that. Broadly, most of the arguments are the same, which is that sometimes protectionism can be good, especially for developing countries. They protect what are called infant industries, which is essentially just like if you're rapidly trying to grow an industry, you don't want big foreign companies coming in because they'll just absolutely obliterate all of your industries and everything like that. So you want to protect your small industries, they can grow and get bigger. And secondly, you want to protect your jobs. So foreign companies will most likely be very, very good at stuff. So they'll be able to give you things for cheap. But the cost of that is they will take a bunch of your jobs. So it's often not worth it for most people, which is why you want to do protectionism. The third broad reason is around regional issues. So there are blocks, which is like the EU is a block, ASEAN is a block, where you want to try and make sure that you economically intermingle. And a good reason for this, that is I think often very useful on extension, is that economic interlinking is really good to stop conflict, like actual fighting between nations. Because when you trade with another country, it is suddenly very, very bad to go to war with them, because you'll lose a bunch of your money, and that's incredibly bad. The reasons why free trade is good are, I think, pretty obvious, which is why I've sort of headlined them just with like efficiency. But it's like stuff will be far cheaper when you just let people sell and when you sort of like let the big companies come in. So it'll mean the market's fairer, like it'll give more money to companies that are good, and it'll also just sort of put prices down. The second thing on trade is contagion. So I think contagion arguments in economics are very, very useful. So I'll try and explain it as sort of simply as I can, which is contagion is if there is an issue of one part of the economy, often what happens is that will cause issues with every other part of the economy. And the reason for this is that economics is very interlinked with one another. So people or firms like pension funds that buy up some assets will also buy up a lot of other assets, and companies will trade with one another such that if the price of one of their goods that they use as an input now gets more expensive, it means their products get more expensive, less people buy them, their shares go down, etc. So an issue in one part of the economy can rapidly proliferate to another part of the economy, even if it's just sort of the perception that things will go down. I think the best way to explain this is to just imagine that you do own shares in something and you think that prices will go down tomorrow. You want to try and sell as quickly as possible to sort of stop yourself from selling at a loss, which is what everyone else is also thinking, which then means everyone sells at the same time. hence like market go down, right? So essentially contagion, or even the perception of contagion, rapidly destroys a bunch of markets in the way that's sort of bad. And the last thing is that trade can have harms. So I think people are really like, economics pilled. Trade can be a very bad thing in some contexts. So firstly, trade can do this thing called Dutch disease, which is essentially where if you put all of your eggs into one basket, it can like screw up everything else. So the example there is Yemen. They invested so much in stuff like oil, they put a bunch of the government's money into it, such that when they ran out of oil, they had no infrastructure or money to do anything else, and it meant that they were much worse off. And it also meant, and this is sort of like the long economics-y explanation, which is just commodities, and especially like oil, gold in particular, are really expensive. So when you sell them a lot, it is pretty good in the short term, but can often mean you're wasting and consuming a bunch of money that is bad in the long term. The second thing is no diversity. So if you specialize in stuff like agriculture and you have like, a blight or a bad growing season, you're screwed and you can't do anything. So you want to try and be a little bit diverse. And lastly, trade causes conflict. So if you've got a bunch of cool natural resources, chances are someone else will think that they're also cool natural resources and might want to take them, which is pretty bad. Okay, the next step is like resources and development. So I've segmented this into two things. Firstly, making more money as a developing state, and then secondly, how to keep the money that you're making. So in terms of making more money, the main way to do it is just to sell more stuff. And primarily you want to get around protectionism. So a fact there is that EU agricultural protectionism deprives developing countries of around 700 billion in export income every year, which is 14 times more than they collectively receive in foreign aid, which could be useful, for example, for APDC round 6, which is like getting money to poorer countries means that they can sell more stuff, which is like the #1 way to get out of poverty. The second thing is around aid. I think there are a few useful statistics I put there. Aid is good, but it has very diminishing returns. So the results generally that most international organizations have found is that after you give aid of like 16% of a country's GDP, you get no benefits. It's sort of like, it's like pouring water into a cup with a bunch of holes. Like nothing ends up happening. And that a lot of aid, whilst it is conditional, some of it gets used in bad ways. So 40% of aid to Africa was used on military spending. So can go to things that are slightly unproductive. Then the next thing you can do is have a cheap labor force, which is broadly just like other companies will want to manufacture stuff in your area if you've got a bunch of people who can make stuff and a bunch of workers who you can sort of exploit. And maybe that's pretty bad in the short term, but it means that in the long term, those people will be better off. That is a trade-off that is hard to navigate. So I don't know, up to your debate. The next one is around stability. This is often something that ends up as like CG extensions in a whole lot of debates. So stuff like disasters and like dealing with corruption can meaningfully mean that companies are more likely to go into your area, or that you're not likely to get people pulling out money because they fear that there'll be like a natural disaster that destroys their port. So you're more likely to get people actually making stuff. And then lastly, just like have a bunch of people who can buy stuff. So if you've got a whole lot of consumers, then companies will want to sell your stuff to you, right? So Apple in India is there because there are like 1 billion people, right? So the #1 thing you want to do is just have a bunch of people who can make a bunch of stuff. All right, then how to keep the money that you're making. So there are a few things to discuss here. The first is like pegging. So I put like peg is pog, question mark. Broadly, the US dollar is something that people tend to peg their currency to. Essentially what that means is like currencies are going like all over the place, which means that they're really, really hard to predict. Pegging a currency is like whacking a nail in it and being like, it will not move and it will stay fixed to whatever the US dollar is. So I don't have my like trashy, terrible currency. I've got lovely, beautiful US dollars. Can this be good? Can this be bad? It varies. So this was the 2022 World's Grand Final, which is like that we regret that we support a decline in the reliance on the dollar. Broadly, it's like, no, the dollar is pretty good. It's very stable. That's one thing about the US government is like, they have a bunch of money. They've got relatively good institutions. But it also means that it's harder to sell stuff. So this is an argument that is very interesting, which is the thing that you can do if you own your own currency is you can make changes based on your own circumstances. So for example, if you want people to do stuff, you can have your reserve bank put down interest rates because you want people to spend money. But if you are pegged, you're just relying on whatever the Federal Reserve does, right? So being pegged, not always great. Okay, the next thing to chat about is where you should invest your money as a developing country. So this was a really, really good debate in 2020 world, which is should you, I believe the topic is like that developing countries should acquire on the global market shares in large companies, which is, I think, a very interesting topic. Gov were like, well, it's very stable and it gives you some sort of control over them that may be good. And I think Op was able to relatively more successfully be like, well, if you invest domestically, that's stuff like jobs, it's pretty good for you. But secondly, I think this is the best argument, which is when you invest in companies on the global market, the times in which you need your money the most are when there's a global recession or the market is down. But when you sell at those times, you're losing a bunch of your money because you're selling when the market's really low. So when you need money the most is when you'll get the least amount of money. And also, and this was the last argument that I believe like the closing runs, which is buying stakes in companies may give you some control over those companies, but it also gives those companies control over you. So relationship of developing countries with the foreign companies that engage in them is quite important and can be very, very useful. Broadly, you want to invest in yourself. I think is like the general upshot of that. Okay, second, lastly, let's talk about microfinance. So the clip I've got is bring your daughter to the slaughter. Microfinance is essentially like debt to start businesses in the developing world. It's mostly used for women and it's very prominent in places like Sierra Leone. So essentially what it is like a big foreign company or an NGO will give a loan to someone and say, go, start a business, and in 1 year you've got to pay us back. And that like seems okay. The problem is it ends up being very, very bad because the interest rates are like absurd. So in most contexts, it will be like 60% to 100% on whatever you've been given. So if someone gives you, like $1,000 to start a business, you've got to pay back $1,000 a year later. Like your business has to make $1,000. And if it doesn't, then you've got to pay back the next year $2,000 and then $4,000, and it sort of like collapses people. And a bunch of women have been sent to jail in a lot of these places because they're like overwhelmed with debt. And the question is like, well, if these things are very bad, why do people take them? The thing is, it's like number one, every other business starts to take them, so people are forced to do so because they don't want to get screwed over and miss out. And secondly, people use these loans and debt to pay off their existing crippling loans and debt. So you're entirely in debt and you're like, I've got to find some way to get out of this debt. So they use the current, they take on an existing loan to pay back another loan, which just sort of entrenches them further into debt. Why is this happening? Broadly, it's that NGOs are being replaced by private companies who just want to make a bunch of money. And then secondly, just societal issues in these places, right? Like there are a bunch of other conditions why it's hard to start a business if you're a woman in Sierra Leone, not just that you don't have some money. There are a bunch of other problems and none of those are really being addressed. All right, lastly, Bretton Woods institutions. So I put a few here. Really, I put two because one of them is broken and the other one is not technically a Bretton Woods institution, but it's interesting, so I wanted to talk about it. The IMF is the main one. There are a ton of debates about the IMF. They mainly do sort of like government balance of payment stuff, which is making sure that governments aren't in debt and are sort of like managing money well. Austerity is broadly the word. Like they do a bunch of other stuff, but broadly they run their government and try and make it sort of hard and fast and sort of strong quickly. So the number one thing that they are concerned about really is being paid back quickly and on time. So the current largest debtor is Argentina, but they've been scaling back a bunch of their money because they've just not countries just haven't been listening to them. So a bunch of the countries the IMF has given money to have defaulted on their loans, which meant they've just wasted a bunch of money. So they're sort of not too hot. The last thing is that they have veto power, though I guess the US has veto power. So the way that the IMF functions is they require an 85% consensus to make any decision, and the US has a 70% sort of like stake in the IMF. So broadly they can veto basically everything. The WTO is next. They do like trade disputes and manage those legal issues. I've just put broken law because they've sort of not been working. The US just hasn't appointed anyone to the board. And the reason that, I guess how the IMF functions is if there is they require everyone to come forward so that they can make decisions. And the United States government has just not put anyone forward, so they can't make any decisions. So they're not doing anything. The World Bank is the next institution to talk about. They're slightly different to the IMF, like they mainly do the same thing, which is that they give out loans to countries, but they're more like building self-focused rather than like running self-focused. So the IMF will be like, run your country very well. The World Bank will be like, here's some money, build some, like some roads, some ports, etc., and hope that you run, hope that it sort of ends up working out. They're more, I guess that they're both sort of like Africa focused. The IMF is currently more in like South America, and the World Bank is doing a whole lot of stuff in Africa. So, like that's the deal. And then lastly, the FTC. So the FTC is not a Bretton Woods institution, but it's such an important institution, I thought I'd include it here, which is that it does like all of the regulatory stuff for the United States, which means basically all of the regulatory stuff that goes down to the rest of the world. And it's run by a lady named Lena Khan, who's sick as fuck. And her, like, in general, her time as like leader of the FTC has led to a huge amount of decisions that are really monumental. So around three weeks ago, they declared, how whenever you open, like, you get a new computer or you get a new phone, Google is the default search engine, which they pay a ton of money to be the default search engine. And the FTC ruled that was a monopoly and that it was illegal, and Google's gonna have to pay a bunch of fines. The other one is that they declared buy now, pay later not as credit, and so it doesn't go to your credit score, which is really important for a bunch of people whose credit was like really, really, really bad. So, that matters a whole lot. The FTC is like broadly pretty good at the moment and pretty important. But again, it's set by the president. So maybe it will change coming the next institution, which could mean very, very bad things. All right, I think that wraps us up for the last bit. I've attached a little slide here that I thought would be useful. Then here's some stuff for sort of further readings. I've ranked them by most to least comprehensible. So at the top, there is a series on YouTube called Marketing Monday. It is actually really good. I don't know a whole lot about Atriarch, but this series is really good. There's a bunch of other stuff. So Warren Buffett's annual reports sound really stupid, but they're made for his little cousin Betsy, who's actually they're really well written. Then there's sort of the ABC Evening News, which is actually pretty good for this. Dan Toomey, no relation, on YouTube. And then some other things. I think the Financial Times and The Economist are both incredibly overrated. They don't really explain much, and often they have a ton of assumptions that are required that break if you sort of consider them a little bit. And then at the bottom I put my lectures, which is sort of there for a reason. All right, here are the debates that we went through, which some of you may find interesting. And then, yeah, that's about it. I tried to include as much as I could. Does anyone have any questions? If not, I will wrap up. Yeah.
I have two questions. Could you go back to the slide about the Bretton Woods one?
Yeah.
So my first question is, what are your thoughts on the IMF, as in terms of the impossible mission force, a la Tom Cruise?
Yeah, not as cool.
Not as cool, not as relevant, perhaps. My second question, you've written Imperial Boomerang. Can you explain what that is?
So that's slightly less useful, but an important sociological concept, which is that when governments do stuff like austerity and colonialism to other countries, they often end up replicating that in their own country. There are a bunch of papers written about it. I believe it's Foucault, but he copied it off someone else. But I think it's really interesting. If you've got a chance, try and have a look at it. Does anyone have any other questions? Yeah.
What's your favorite financial derivative?
Puts. Well, I just think all derivatives are kind of silly, but yeah.
What's a financial derivative?
Well, you don't need to know. Is the actual answer. So the broad thing is you can oh yeah, hold on. You can bet on anything, protecting time. You can bet on anything in the stock market, basically. And so derivatives are I made a bet that this other stock would increase by a set amount in a certain amount of time, and I want to have the option to buy it when it goes to this exact price. It's a bunch of sort of gambling related things that you can do on the stock market that are all useful if you're, I don't know, a real degenerate, but not otherwise useful. Yeah. Anyone have any other questions? Jez? Oh, do you have your question? No? Okay. All right. Okay, awesome. I think that's about it. Thanks very much, everyone.